So now the converting assets to expense. So when a business makes an expenditure that will benefit for more than one accounting period, the amount usually is debited to an asset account. At the end of each period benefiting from this expenditure, an adjusting entry is made to transfer an appropriate portion of the cost from the asset account to an expense account. This adjusting entry reflects the fact that part of the asset has been used up or become an expense during the current accounting period. So an adjusting entry to convert an asset to expense consists of debit an expense account and credit an asset account. A contra asset account. So example of this adjustment include the entries to apportion the cost of, let's say, prepaid expenses and entries to record depreciation expenses. So here we will discuss that first, whatever at the time when the business is going to pay some amount of money for the future expense, so this will be considered as unexpired and prepaid expense. So this would be basically a journal entry, that is, let's say, insurance expense, prepaid insurance is debit and cash is going to be credit. But when at the end of a specific period of time, when the current period has been passed, so certain amount or a portion of said prepaid expense will be expired. So this amount will be realized as an expense account according to that period of time. So recognize the portion of asset consumed as expense, so we will record. So here remember we have recorded an entry that was prepaid insurance debit and cash credit. Now we are transferring that prepaid asset as because it is used up, so we are crediting that portion of asset because it is used up, and we are debiting the insurance expense. So the amount that is expired out, this will be debited, and the portion of the asset that is used up in that particular time period, this will be credited. So the entry, the adjusting entry that needs to be adjusted, that is simple, that is insurance expense debit and prepaid insurance credit. On the other hand, you can see that the recognized portion of asset consumed as expense, this will be debited, and reduced balance of asset account, that is credited. So that means you need not to worry about the real accounts, okay? Because when we pass the entry that how much proportion of the asset that is expensed out, so automatically it will be adjusted, and for the real account the remaining value will left over. So you can see here that if we, let's take an example like depreciation supplies or expiring insurance policy. So you can see that for the sake of example, for instance, $2,400 insurance policy coverage for 12 months. That is 2,400 divided by 12, so that means $200 per month, okay? So if the insurance policy has been purchased on Jan 1, that is, you can see here that on January 1st, WACO purchased a one-year insurance policy for $2,400, right? Now, this insurance policy will completely be expired on December 31st after 12 months, right? Let's say if the firm is going to close its account after 1 month, or they are passing the adjusting entries on monthly basis. So in that situation, what would happen? That they will pass that first they will pass the journal entry, that is prepaid insurance or unexpired insurance is 2,400 debit and cash is credit, that is they have purchased a one-year insurance policy. So initially the cost that benefit for more than one accounting period are recorded as an asset. Then when it comes to pass the journal entry, so the cost, the portion of that asset that is expensed out in that accounting period, let's suppose the firm is passing the adjusting entries on monthly basis. So only 200 is expensed out, so we can say that insurance expense of $200 has been expired, and this same amount is reduced from the asset. So now after this adjusting entry, you can notice that in your balance sheet the prepaid insurance amount will be 2,400, because initially the nature of the account was 2,400. You can see here that the nature of unexpired insurance is 2,400, and because the nature is asset, so first you will record on 1st of that month 2,400 on the asset side, right? And then you have noticed that on 31st of January, 200 out of 2,400 has been expired. that means 200 worth of asset decrease. So according to the rules of debit and credit, when the assets are going to decrease, it will be posted on the credit side. So if the assets are going to decrease, then it is being posted on the credit side. So you can see that whenever you are going to balance them off, now the remaining asset value is 2200. On the other hand, you can see the impact on the income statement, that the cost of the asset that is used up in this year, in this period, you can see that the insurance expense and the nature is expense. So when the expense is going to increase, it will be posted on the debit side. So you can see the expenses are increasing, so that is why we are posting on the debit side, and the assets are decreasing, so it will be posted on the credit side. Now the concept of depreciation. So in depreciable assets, now what is depreciable assets? So depreciable assets are physical objects that retain their size and shape, but that eventually wear out or become obsolete. They are not physically consumed as are assets such as supplies, but nonetheless the economic usefulness diminishes over time. Examples of depreciable assets include building and all types of equipment, fixtures, furnitures, so and even railroad tracks. Land, however, is not viewed as a depreciable asset, as it has an unlimited useful life. Each period, a portion of a depreciable asset usefulness expires. Therefore, a corresponding portion of its cost is recognized as depreciation expense. So, what is depreciation? So, in accounting, the term depreciation means the systematic allocation of cost. Depreciation is not an attempt to record changes in assets' market value. In short run, the market value of some depreciable assets may even increase. But the process of depreciation continues anyway. The rationale for depreciation lies in the matching principle. Our goal is to offset a reasonable portion of the asset's cost against revenue in each period of asset's useful life. Depreciation expense occurs occasionally over the life of the asset, but there are no daily depreciation transactions. And in fact, depreciation expense is paid in advance when the asset is originally purchased. Therefore, adjusting entries are needed at the end of each accounting period to transfer the appropriate amount of the asset's cost of depreciation expense. So that when you are going to purchase an asset, so let's say, for example, you have purchased an asset that is worth 100,000, and that $100,000 and its useful life, or its estimated useful life, is, let's say, 5 years. So now the cost will be divided by the estimated useful life in order to find out the annual depreciation. So let's say if you have purchased worth of $100,000 of long-term assets or a non-current assets, or you can say the fixed asset, it will be divided by 5. So that means every year you have to adjust or pass an adjusting entry of depreciation expense, that 20,000 of the depreciation expense has been incurred. So the portion of assets utility that is used up must be expensed in the period used. So the transaction that on date when initial payment is made, so you will record an entry that is fixed assets debit and cash is going to be credit. Now the asset's usefulness is partially consumed during the period. So after an accounting period, you will record that the depreciation expense debit and the accumulated or provision or allowance for depreciation will be credited. Right? So in this way, we can take the example here. Like on May 2nd, 2003, JJ Lawn Care Service purchased a lawn mower with a useful life of 50 months for $2,500 cash. Now you can see that the amount of the asset is $2,500 and it will remain useful for JJ Lawn Care Service for 50 months. So 2,500 divided by 50, so you can calculate out that the monthly depreciation is 50. Here we are using the straight line method. Okay, so $50 will be the depreciation expense. So now if you are going to pass the first entry, so 2500 is the amount, and you will pass the entry that is the lawnmower is going to be debit by 2500 and cash will be credited by 2500. One asset is increasing and other asset is decreasing. On the other hand, when at the end of the month, if you are going to pass the adjusting entry, so here you can see after 1 month, the depreciation expense on this tools and equipment like earth mover is 50 and accumulated depreciation is going to be credited at the end of the first month. And similarly, if you are passing the adjusting entry on the yearly basis, so definitely you will divide it by the number of years, the useful life of the plant or asset or non-current assets. Similarly, taking another example, that the cost of the truck is 15,000 is depreciable over 60 months as follows. So that means 15,000 divided by 60 months. So on monthly basis, if you are adjusting your records or accounting periods as on monthly basis, so monthly depreciation will be 250, and you can see that the adjusting entry that would be passed is depreciation expense debit and accumulated depreciation credit. Now the accumulated depreciation is definitely the depreciation expense is the amount of expense. This will affect the income statement, whereas the accumulated depreciation is the part of the real account. This will definitely brought forward in the balance sheet, and it will be subtracted from the cost of the plant to get the net book value. So you can see that the value or the amount or the worth of tools and equipment was 2650, and after subtracting the accumulated depreciation of 50, now the net book value remained to 2600. Similarly, the cost of the truck was 15,000 and subtracting 250, that is the depreciation accumulated till yet. So you will get the net book value or net realizable value is 14,750. So now the second adjusting entry, that is converting liabilities to revenue. So in some instances, customers may pay in advance for services to be rendered in later accounting periods. For accounting purposes, amounts collected in advance do not represent revenue because the amounts have not yet been earned. Amount collected from customers in advance are recorded by debiting the cash amount and crediting an unearned revenue account. Unearned revenue also may be called as deferred revenue. Let's say when a company collects money in advance from its customers, it has an obligation to render services in the future or return the amount of money what they have received. Therefore, the balance of an unearned revenue amount is considered to be a liability. It appears in the liability section of the balance sheet, not in the income statement. So unearned revenue differs from other liabilities because it usually will be settled by rendering the services rather than by making payments in cash. So in short, it will be worked off rather than paid off. Of course, if the business is unable to render the service, it must discharge the liability by refunding money to its customers. But in usual case, the business will going to render its services for the amount the business is taken for. So when a company renders the service for which the customers have paid in advance, it is working off its liability to these customers and is earning the revenue. At the end of the accounting period, an adjusting entry is made to transfer an appropriate amount from the unearned revenue account to a revenue account. This adjusting entry consists of a debit to a liability account, that is unearned revenue, and credit to the revenue account. So here you can, that is in the converting liabilities to revenue. So first the transaction will be passed, that is collected from the customers in advance and creates a liability. So that means you can say that you have received the cash in advance from your customers, but you haven't delivered the goods or you haven't rendered the services yet. But at the end of the period, when you rendered the services or some proportion of the unearned revenue is rendered, so you will recognize that portion of earned as revenue and you will debit the unearned revenue and you will credit revenue income or revenue earned. So the reduce in the balance of liability account and you will recognize the portion of earned as revenue. For the example, you can take the airline ticket sales, the sport team sales or the season tickets. So here, let's suppose $6,000 rental contract coverage for 12 months. On January 1, VAPCO received $6,000 in advance for a 1-year rental contract. So now the VAPCO has received $6,000 in advance for 1-year rental contract. That is 500 monthly rental revenue. That is 6,000 divided by 12. So at the time when they receive $6,000 on 1st of January, so the VAPCO will record that cash is going to be debit, 6,000, and it is completely their liability, and they will record unearned revenue 6,000 credit at the beginning. But as they are going to render the service, or they will let to live the firm, like initially revenue that benefit more than one accounting period are recorded as liability, but you can see that cash debit and unearned revenue credit, and then immediately the adjusting entry, like over time the revenue is recognized that it is earned. Say for example, the entry is recorded on monthly basis, so unearned rental revenue is 500 debited and rental revenue 500 credited, right? So here you can see the effect, that is balance sheet effect, that liability for future period. So initially $6,000 was the unearned liability, unearned revenue, and after 1 month, the services worth of $500 has been rendered. So the liability is going to decrease, and you know that when the liability is going to decrease, it will be posted on the debit side. So the remaining amount of liability that is still there in the balance sheet is 5,500 by balancing of the situation. And the rental revenue, when the revenue income is going to earn, so when the revenue or income is earned, it will be posted on the credit side. So this is the effect on income statement, that revenue earned this period, and this is the effect on the balance sheet.
Thanks for watching. For new video updates, press subscribe button so you will notified.